Welcome back. We are now busy with Unit 6, Retirement Fund Investments, which form part of the class of Business 4, Retirement Fund Benefits. We'll discuss in the next part of this session retirement planning being a critical part of any financial plan. Savings for retirement is a long-term commitment, and investors need to ensure that their hard-earned money is in safe hands and the correct investment decisions are made on their behalf. Trustees need to exercise their fiduciary duties when investing the assets on behalf of their fund members. This unit, we will look at the regulatory framework and propose best practices guiding trustees through this process. In addition to the legislation, the financial planner must also be aware of the investment products to direct trustees to the best investment strategies for their specific funds. The trustee's duty is to invest fund assets. The fund main objective is to provide members with meaningful retirement benefits. The trustees are responsible for the fund investments, especially under defined contribution funds, where the members carry the investment risk. Trustees must ensure that the fund's assets are invested in a way that complements and is consistent with the ability to the fund and to meet the present and future liabilities within the confines of the investment regulations applicable. The trustees may delegate the technical aspects of this duty to an asset manager. Still, it remains the overall responsibility of the trustees to ensure that the fund meets its objectives, which are to achieve real investment growth over the long term and actively manage the risk of loss of assets in the short term. The trustees must continually monitor investment returns and exposure to risk and attempt to achieve an optimum balance between the risk and the return. If the trustees find that investments has become unsound or too risky, or simply does not provide an adequate return, it would be their duty to disinvest and seek better alternatives, ensuring that proper arrangements are made to allow best possible returns in the interim, should this be necessary. What is an investment portfolio? An investment portfolio is a combination of different types of asset classes. A portfolio can have portions invested in various asset classes or investments such as shares, properties, alternative investments, bonds, and cash. A balance of the different asset classes is required to provide the best returns at the best possible levels of risk. It is the blend of the different asset classes that will constitute the fund's investment portfolio. We will focus our attention on the different asset classes to briefly understand their description and the important characteristics of these classes. Right, if we look at the type of assets and we look at shares and stocks, they represent shares of ownership in public held companies, historically have outperformed other investments over the long period, but keep in mind that past performances does not guarantee future results because the company might suffer losses. We've seen this in the case of Steinhoff, where the Steinhoff company's shares fell by almost 96% after it became known that there was fraudulent activities within the company. And since then, we have seen that it has not yet recovered. Most volatile asset classes in the short term, when redeemed, the returns and principal or capital assets will influence so that accumulation may be worth more or less than the original costs. That is shares or stocks. Bonds are interest-bearing instruments, but usually involve a longer period to maturity, typically 5, 10, 20, or even some can be 30 years. Governments, local authorities, parastatals, and corporates borrow money from investors by issuing debt instruments called bonds. By holding a bond, an investor is usually entitled to an annual cash interest payment fixed at the purchase time. While this locked-in interest rate may seem safer, it exposes investor to more risk. If inflation or short-term interest rates go up during the period to maturity, the investor loses out. Bonds are low to medium risk investments and provide low to medium returns over time. You look at money market funds or money market investments. Several money market instruments include treasury bills, commercial papers, bankers' acceptance, deposits, certificates of deposits, bills of exchange, repurchase agreements, and asset-backed securities. Instruments bear differing maturities, currencies, credit risks, and structures, and thus may be used to distribute exposure. If we look at property as an asset class, it covers the whole ambit of real estate investment, from rural estate to office blocks. It is a medium to high risk asset class with returns proportionate to the risk. The property market is generally adversely affected by interest rates. It tends to have a low correlation with interest bearing investments, especially cash. Then we can look at alternative investments as an asset class. They include venture capital, private equity, hedge funds, real estate, investment trusts, commodities, and real estate assets such as metals, rare coins, wine, and art. These assets usually perform with a low correlation to stocks and bonds and may be difficult to value and are generally more illiquid than your traditional type of investments. Private equity consists of investors and funds that invest directly into unlisted companies or private companies. You get hedge funds. A hedge fund is an investment fund that pools capital from a limited number of institutional investors and invest in a variety of assets, often with complex portfolio construction and risk management techniques. Many hedge funds' investment strategies aim to achieve a positive return on investment regardless of whether markets are rising or falling, but come at a cost for such protection. Then you get commodities, practical goods such as gold, copper, crude oil, natural gas, wheat, corn, and even electricity. It helps to protect future purchasing power as values have fixed utilities and thus run parallel to inflation. Values tend to exhibit low correlations with the stock and the bond prices. And then we can look at foreign assets. These are investments in any of the above assets in markets outside of your own and usually in a different currency. Right, Regulation 28, guidelines on retirement fund investments. Regulation 28 of the Pension Fund Act governs trustees' investment decisions. Revised Regulation 28 was implemented in July 2011 and applied to all private retirement fund assets worth approximately 1.1 trillion and may be extended to the government employee pension fund, including another 1 trillion. Retirement fund investment regulations aim to ensure that the savings South Africans contribute towards their retirement are invested in a prudent manner, which not only protects the retirement fund members, but also is channeled in ways that achieve the government's economic development goals and growth. The FSCA recognized that there is a general lack of investment expertise amongst trustees, and thus principles were introduced in Regulation 28 to strengthen the investment decision-making process. These principles also improve the transparency and accountability to members and the registrar. It is important for trustees to include these principles in the investment policy statement. These principles include to ensure that the fund assets are appropriate for its liabilities and to perform appropriate due diligence on investments, considering the risks relevant to the investments, including but not limited to credit, market, and liquidity risks, as well as operational risks, assets not listed on an exchange. To promote the education of the board with respect to pension fund investments, governance, and any other related matters, to monitor compliance with the regulation by its advisors and service providers, in contracting service to the fund or its board, to consider the need to promote broad-based Black economic empowerment of those providing services, Before making a contractual commitment to invest in a third-party managed foreign asset or investing in a foreign asset, to perform reasonable due diligence considering risks relevant to a foreign assets, including but not limited to currency and or country risks. To understand the changing risk profile of assets of the fund over time, considering comprehensive risk analysis, including but not limited to credit, market liquidity, and operational risks. To apply a look-through principle to the investments of a fund. To consider the long-term sustainability of investments, considering impact of environmental, social, and government aspects. Right, to just link it to practice, the principles of Regulation 28 points the trustees towards clearly designing their fund investment strategy around their fund's liabilities while mitigating the risk. It goes beyond that, however, to draw their attention to the bigger environment in which they operate in terms of empowerment and sustainability. As financial planners, it's important to understand the fund's liability profile and members' needs as the first step in the investment process. The assets limits and sublimits. The regulation does not dictate in which actual assets or fund should be invested, as this would counter the principle guiding a fund to act in its members' best interest. However, the regulation does set maximum limits on asset classes in which the fund may invest. Importantly, these asset limits apply to the member level. In other words, each member investment in the retirement fund needs to be comply with the investment restrictions imposed by the regulator and regulations using a look-through principle down the underlying shares. In terms of the look-through principle, a fund cannot use an asset structure to circumvent the set limits set out in the regulations. The fund must look through the linking structure of its investment allocations and disclose the underlying assets. The investments of the pension fund are mandated to be managed within the prescribed limits set in Regulation 28. Regulation 28 provides guidelines on how different asset classes can be utilized by retirement funds in investment portfolios and maximum exposure per asset class. The fund should request a certificate from the respective investment managers confirming the assets comply to Regulation 28 limits, providing that the auditors of the respective asset managers confirm the accuracy of such certificates, which shall be presented to the trustees on an annual basis and form part of the fund audit points. Right, if we look at Pension Fund Circular 130, Pension Fund 130 deals with the governance issues in general that apply to retirement funds, as we have discussed in the balance of Unit 6. However, it is worthwhile considering the implications of Pension Fund Circular 130 on a retirement fund's investment strategy at this point to bring a total perspective to the discussion of investments. It should also be borne in mind that pension fund circulars are not the law. These are circulars issued by the registrar to clarify legislation interpretations or recommend best practices. While the pension fund circular are not legally enforceable, the registrar looks for more favorable upon the fund which comply, and failure to follow their recommendations may have to be justified if any issues should arise. Thus, the financial planner needs to be aware of the content and advise clients of the best practices that is recommended by the registrar. The requirements of Pension Fund Circular 130 requires a full profile of the member of a fund to enable the trustee to identify the percentage of assets required for short, medium, and long-term investment, as well as the risk profiles attached to each category of beneficiaries. It involves an actuarial approach which will give the trustee sufficient information to allocate funds appropriately to ensure the liquidity and risk factors match those relating to the liabilities of the fund. I would suggest that you draw a copy of the Pension Fund Circular 130 off the FSCA website and study the whole document so that you can have more information on this. A fund investment policy statement, or IPS, in terms of the pension fund 130 document that was issued by the FSCA, every fund needs to have an investment policy statement, or IPS, which should be reviewed annually and disclosed to all the stakeholders, namely the beneficiaries, investment managers, and any relevant regulatory authorities. Annexure B to PF 130 provides guidelines as well as requirements of the IPS. For the purpose of the fund's IPS is to specify the investment objectives of the fund, outline the fund's overall risk philosophy, shape the fund's broad investment strategy to be followed to meet the fund's objectives, set out the implementation of investment management process necessary to carry out the strategy, and establish criteria for how investment managers will be selected, remunerated, and replaced. The fund IPS should also include at least the following information: where are the fund investment advisors? Who are the custodians of the investment are, where applicable? Whether the fund has a socially responsible investment policy as its definition of such investment type, whether the investment of the fund are in the form of an insurance policy or a segregated mandate, and the reason therefore, what are the targeted performance benchmarks are in respect of each asset manager and asset class held by the fund, and what the previous year's actual performance was concerning the fund's benchmarks, as well as the tracking error, the level of risk attributed to each asset class and the asset managers, and whether or not the fund exercises its ownership rights in respect of investments held by it, and if so, what the proxy voting policy is, and if not, the reasons therefore. Right, retirement fund investment options are explored in line with the fund's liability profile and risk tolerance. The trustees are faced with numerous investment products available to them. The financial planner must be able to distinguish between the different types of investment options, be able to guide the trustees to the right choice for their fund. Segregated and pooled portfolios or retirement fund investment portfolios are managed on either a segregated or a pooled basis. Pooled products are generic, off-the-shelf type of products where the investment manager manages the investment of many investors in one portfolio. Segregated portfolios are customized investment portfolios that are designed for that specific retirement fund. Now let's look at segregated portfolios. Under a segregated investment mandate, the trustees engage with an investment manager to manage and invest portfolios on behalf of their fund only. The fund's assets are held in the fund's name, and the investment manager will invest the assets exclusively according to the trustee's specific mandate and report to the trustees at agreed intervals. The trustees may decide to change the mandate at any time they wish. The segregated portfolios thus offers the trustees considerable flexibility and, together with that, consumerate risk. By actively mandating the investment manager, the trustees may assume additional liability should they not monitor the investment or the mandates closely or regularly enough. In practice, only funds with over 100 million in investments can have investment managers run portfolios on a segregated basis. At 100 million, the investment manager can deliver meaningful diversification. Funds with investments less than this are better off looking at a pooled portfolio. Now, what is a pooled portfolio? A pooled portfolio provides a set mandate for the investment of the assets for all the investors who have chosen to invest in this portfolio. It means that trustees choose rather a suitable mandate for their fund from portfolios that already exist rather than structuring a specific mandate and portfolio for their fund. Where assets are invested in pooled portfolios, they are registered in the insurer's name and not in the fund's name. A policy of insurance is issued to the fund, set out the rights and obligations of the parties, including the fee scales and the disinvestment conditions. Even though this is an insurance policy, some of the terms are negotiable, and trustees should ensure that they carefully review the terms and the conditions of the policy before making an investment. Right, let's have a look at market-related and smooth bonus mandates. A market-related portfolio. At the end of the day of each trading, investment managers calculate the unit rate, showing the rise or the fall in investment portfolio due to investment returns. So as the market moves up and down, this unit rate or unit price is allocated to all investors in the portfolio at the end of each day, meaning that the value of the fund assets will rise or fall daily as this unit price changes. That's the market-related portfolios. If we look at the smooth bonus portfolios, some investment managers provide smooth bonus portfolios where the unit prices or returns are smoothed over a period. It means that investors don't experience the full upside of unit prices on the one hand, but then are protected to some degree from the full downward movement in unit prices on the other. Smooth bonus portfolios have fallen out of favor with investors given their lack of transparency and often severe termination conditions. Right. If we look at selecting an investment manager in line with the fund's investment policy statement, once the trustee have put together the investment policy statement, understood whether they would prefer segregated or pooled portfolios, and opted for a market-related or a smooth bonus allocation of returns, the attention then must fall to the selection of the investment manager. Right, now we can have a single manager approach. That's when adopting a single manager investment philosophy, the trustee retains the responsibility of selecting the various investment manager or managers for their fund's investment. In addition to selecting the investment managers, the trustees also decide the portion of their total fund allocated to their respective investment managers. The trustees thus assume responsibility for ensuring the optimal blend of investment managers to meet the identified objectives of their IPS. One could say that the trustees assume the responsibility for the meaningful diversification of these investment managers. If we look at the multi-manager approach, given the complexities associated with a single manager approach, many trustees choose to use a multi-manager process or approach. A multi-management is an investment strategy where a multi-manager constructs an investment portfolio by utilizing the expertise of various underlying investment managers. The role of the multi-manager is to combine the different investment managers and decide on the asset allocation, how much of each asset class should be in a portfolio. The underlying managers can thus focus purely on delivering superior returns. Right, then we get various portfolio management styles. The art of selecting the right investment policy for investments in terms of minimum risk and maximum return is called portfolio management. There are predominantly active and passive portfolio management styles. The choice will largely depend on the economic environment in which the investments are being made. Sometimes a blend of the two styles give the best blend. With the help of the investment consultant, the trustee will determine what suits the fund in the specific economic environment the best. Below, we're going to give on the next slide just a description of each of these styles. Right, if we look at the active portfolio management, as the name suggests, portfolio managers select financial securities to outperform an index by buying and selling securities to ensure maximum profits in an active portfolio management service. Active managers rely on the research, forecasts, expert judgment, and experience in making investment decisions on which securities to buy, which to hold, and which to sell. On the other hand, the passive portfolio manager, also known as indexing, entails selecting financial securities that mirror the performance of an index or a benchmark of interest. Passive investment followers believe in the efficient market hypothesis, which states that the prices of financial securities always incorporate and reflect all publicly available information. There are no mispriced securities. Passive investments work well in an investment environment that has good informational efficiency. It is also known as a strong form of the efficient market hypothesis. Factors to consider when deciding on an approach: the level of market efficiency, economic cycle in which we are, investment objectives of the fund, the level of diversification of the index, the cost of the strategy or the approach that you will take, the expertise of a portfolio or an asset manager, the liquidity of the index, regulations, explicit, implicit requirements put there by the regulation, and then also social impact or ESG. Key investment fundamentals for retirement funds. Now let's just look at fundamental number one. Retirement investments are long-term. Retirement savings essentially have an horizon of about 40 years to maturity, which is crucial in considering the portfolio investment strategies. Trustees should therefore design portfolios that beat inflation by significant margins over the long term to retain real value in member benefits. It is essential, therefore, to carry some degree of risk. The major determinants of asset allocation are the time horizon to retirement and the investment risk portfolio of the portfolio, the investment profile, of the portfolio. Now, if we look at time horizon, it is the expected duration of the investment. Investors with a longer time horizon may feel more comfortable taking a riskier or more volatile portfolio because you've got time to write this out. When retirement fund portfolios are constructed, they are done taking into account the demographic profile of the fund. Usually, special portfolios are designed to protect members' assets when they are close to retirement. Right, then risk tolerance is the willingness to experience both positive and negative returns on the portfolio assets. There are essential three classes of investors. For example, you get your aggressive investor, a conservative investor, and then you get your more moderate investor. Right, if you look at investment fundamental number two, shares outperform the other asset classes over time. So given time, shares will outperform your other asset classes like property, cash, and so on. History has shown that the equity market rewards an investor with inflation-beating returns in the long run. Still, to be able to keep the rewards, the investor must be able to tolerate short-term volatility. We will use the Johannesburg Stock Exchange or the JSE, the bond market, and inflation to show this because of its stability over the years. The stock market has the highest volatility in the short term, and trustees and members must be aware of this characteristic of the JSE. It is therefore important to note that this is a crucial investment for funds to achieve its long-term growth objective. The lower the allocation to shares, the lower the probability of achieving long-term returns that is above inflation. Right, from fundamental number three, there is no reward without risk. So if you don't take risk, you will get not much more. When it comes to investing, risk and rewards are very closely linked. You have probably heard the phrase, no pain, no gain. Those words come close to summing up the relationship between risk and reward. Do not let anyone tell you otherwise. All investments involve some degree of risk. Over the long term, even cash has an element of risk because the return of a cash portfolio may be below inflation, which means that the purchasing power, how much you can buy with your money, will decrease over time. So that's a risk that you run with cash. The reward for taking on risk is the potential for a greater investment return. Suppose you have a financial goal with a long-term, a long time horizon. In that case, you are likely to make more money by carefully investing in asset categories with greater risk, like shares or bonds, rather than restricting your investment to assets with less risk, like cash equivalents and cash investments. Because cash is not going to grow much because they are very dependent on the interest rate offered to you. And then there's also your tax liability on interest if it's above a certain amount. Right. Fundamental number 4 is diversification is key. Diversification is a strategy that can be best described as don't put all your eggs in one basket. So you've got to diversify between various asset classes. The strategy involves spreading your money amongst various investments like shares, bonds, cash. You could put properties, alternative investments, whatever in there, to the hope that if one loses money on the one investment, you will more likely be making up your money on another investment. Right, then the investment policy statement. Trustees should agree on an appropriate investment policy for the fund and, where relevant, place limits on the fund's investment in specific sectors, markets, shares, and or other securities. In the case of a defined benefit fund, the employer must be consulted on the investment policy because the employer takes the risk. Trustees must ensure that the investment policy statement complies with applicable investment regulations and the investment strategy accordingly. Concerning the investments of the fund, trustees must invest with care that an ordinarily prudent person would take in investing for the benefit of other people for whom he or she felt morally bound to provide. Trustees must invest solely in their best interest, as the fund's purpose is to provide benefits for members and other beneficiaries. In this context, best interest should be taken to mean the best financial interest of the people that you invest for. Remember, this is not money that you can gamble with and see whether you are a very smart investor. This is money of your beneficiaries, and you should handle it with care. Trustees must also invest the assets of the fund in a manner appropriate to the circumstances of the fund. For example, they must review the general circumstances, such as the age profile of the members of the fund, and invest the assets appropriately. So obviously, if your age profile is high and your fund member has got shorter period of time, then you need to understand that you've got to invest more prudently and in a more safer investment. The basic investment requirements or basic requirements are: the fund's assets must be invested in a manner designed to ensure the security, the quality, the liquidity, and the profitability of the portfolio as appropriate as regards to the nature, duration of the expected liabilities of the fund. The trustees must invest the assets of the fund predominantly in regulated markets. Investments in assets not admitted to trading on a regulated market must be kept to a prudent level. Fund assets must be appropriately diversified to avoid excessive reliance on a particular asset, issuer, or a group of undertakings. So make sure that you invest the money in a prudent way and in a safe way for your beneficiaries. Right, if we look at guidelines for determining an investment strategy of the fund, first you'll have your investment objectives. Then you need to determine the risk profile of the people in the fund, determine the benchmark for that specific fund, design mandates and individual benchmarks, review your investment products that you're going to use for investment, do due diligence checks on these investment products, measure your risk and your return, and then once you've now invested the money, it is important that you provide a regular feedback to your beneficiaries and those on behalf of whom you are investing the money. Right, let's continue with the Statement of Investment Policy Principles, or SIPP. Even where the trustees appoint an investment manager, they remain responsible to the beneficiaries for the investment of the fund assets. So you can't walk away from that. You are responsible. Elements that the SIPP should contain are fund investment objectives. For defined benefit and defined contribution funds, when no member investment choices is available, the trustees would expect this to include the objectives of meeting the liabilities and the attitude to risk. For the defined contribution fund, the trustees would expect it to include a description of the rationale for the investment choice made available to the members. The fund's investment objectives must be unambiguous and measurable and reflect the fund's risk tolerance levels. The investment objectives set by the trustees will inform the choices of asset managers who will be appointed to manage the fund. As far as measurement of the investment risk, the trustees expect that this would identify the investment risks faced by the fund and how these risks are measured. Different funds use different approaches to measuring risk, and no one approach is prescribed. Defined contribution funds may choose to provide a separate response for each of these investment funds. A risk management process to be followed. The trustees would expect this section to describe how the fund trustees manage ongoing investment risks. There are many possible approaches. For example, the SIPP may include the guidelines provided to the investment managers and a policy statement relating to the periodic reviews of investment performance and risk. Again, defined contribution funds may provide a separate description for each fund. And then strategic asset allocation. For defined benefit funds, the trustee would expect a statement of the asset allocation strategy and how the nature of the liabilities of the fund has been taken into account in setting it. For defined contribution funds, the trustee would expect this section to include a description of the available investment funds and any restriction on members' investment choices. So that deals with the Statement of Investment Policy Principles. Right, investment vehicles available to retirement funds. Guaranteed funds. Guaranteed fund portfolios are generally only offered by life assurers and relieve the trustee of some of the investment risk. The guaranteed provide under these types of portfolios mean that regardless of the market value of the underlying assets, the insurer guarantees that the fund will be paid on a certain nominal value. In other words, there is an attempt to even out the peaks and the troughs of the investment returns and retain a margin to allow for future uncertainties. As such, these portfolios are particularly suitable for funds with a low risk appetite, small funds, many members nearing retirement, and funds with erratic cash flows. Funds with the above profiles would not tolerate negative movements in the market value. The guaranteed fund also offers capital guarantees and low volatility while still achieving superior competitive returns over the long term. Investment returns are distributed through bonuses declared yearly or monthly by the insurer. In good years, a reserve is created by holding back some of the returns. The reserve will be used to supplement returns then again in bad years. Volatility, therefore, is reduced as far as possible. Right, then if you look at guarantee funds and their functionality, market volatility is removed through smooth bonuses. Bonuses are declared monthly or annually in arrears and consist of vested and non-vested portions. All capital invested in vested bonuses, once declared, are guaranteed. The key features of guaranteed funds is provide investors with a guarantee on all capital invested and vested bonuses declared, distributes investment earnings by way of smooth bonuses, diversify underlying portfolios, and provide long-term real returns. If we look at the market-linked funds, this is not a guaranteed fund, but a fund linked to the market. With a market value investment, managed direct investment, there can be no question of hidden reserves as market fluctuations are immediately reflected in the value of the portfolio's asset. The asset manager provides no guarantees and the fund experiences the full volatility of the market. The essential advantage of the managed fund portfolio is that it provides full fund participation in investment returns. Concurrently, however, there is corresponding volatility. The disadvantages in comparison to the guaranteed portfolio are that there are no guarantees of investment values. Hence, if the trustees or the members do not fully understand the fluctuation of market values, they may distrust the fund manager and think he's not doing his job. The market-linked portfolio are normally named after their volatility and their risk exposure. Right, so if you look at the various market-linked funds, aggressive, moderate, absolute return, and conservative, your aggressive portfolios typically have relatively high exposure to equity investment shares. They typically target return objectives of CPI plus 7% over a rolling 3-year period. Your moderate funds, these portfolios are suitable for long-term investors seeking reasonable growth but requires less volatility than can be expected with aggressive portfolios that reduce equity exposure. The target of these fund returns would be an objective of CPI plus 5% over a rolling 3-year period. Then you get your absolute return funds. These portfolios are suitable for funds which seeks reasonable growth but wish to preserve capital over the short term. Fluctuations are less likely, but as the risk of short-term negative returns is reduced, the long-term performance is expected to be lower than that of moderate and or aggressive funds. Their target are usually set over a 12-month period and not 3-year rolling period. Your conservative funds, these portfolios offer capital guarantees with reduced volatility relative to moderate and aggressive portfolios, whilst the risk of capital loss and fluctuation of return is reduced. The long-term return expectation is lower than that of other portfolios, obviously because they invest more conservatively. The target return objective of CPI plus 3% is looked at over a rolling period. Right, if we look at other investment approaches used by funds, your single manager approach and then your multi-manager approach. The single manager approach, the assets are all invested in a single portfolio. The fund performance is therefore directly dependent on the performance of the appointed manager and the selected investment portfolio. With a multi-manager approach, the multi-manager investing is a simple concept that aims to deliver returns and manage risk, unlike a traditional fund where a single manager fund controls all the money and investment in a fund. Multi-manager portfolios spread the assets across different asset types and fund managers, not putting all the eggs in one basket, helping diversify the investment portfolio and reduces exposure to risk. In a single manager portfolio, if the investment does not perform as well, the trustees have two options: hope that the fund manager get their act together or cut their losses and look for another fund to invest. On the other hand, in a multi-manager investment, it relies on many different fund managers picked by a professional team. The overall performance is expected to be better in the longer term. A multi-manager approach allows a high degree of diversification in terms of a large number of underlying stocks and a range of investment styles and strategies. In this way, a portfolio fund can enhance investment performance through the superior stock and bond picking skills while reducing risks through an appropriate diversification of assets, strategies, and different styles. Right, fund investment designs, single portfolios for all members, one size fits all. All the fund assets are invested in the same portfolios without regard to the different ages, financial literacy, risk appetite profiles, and special needs of individual members. The trustees will select the portfolios they believe will offer the best returns. It can be used especially where the fund has a lot of young members and would not be viable to create other portfolios for the older age groups where the portfolio is too small to be split up. A lifestyle investment approach. A lifestyle strategy is a customized investment strategy designed considering the member's age and expected time to retirement to maximize the post-retirement income of retirement fund members while considering the risk profile of the age group. A fund could thus divide into three bonds, are exemplified below, assuming a retirement age of, let's say, 65. Right, so if we look at a lifestyle investment approach, a lifestyle investment strategy takes changing investment needs based on time to retirement into account. The benefits of investing in a lifestyle strategy include: one, simplified decision making regarding funds to invest in, exposure to high growth investment assets early in the member's career, and allow for preservation of members' assets as the member approaches retirement. So you've got the growth stage, 18 to 55 years. You've got your consolidation stage, which is 56 to about 62 years of age. And then you've got your preservation stage from age of 63 to around about 65. Right, if we look at fund investment designs, individual investment choices by members, some retirement funds allow members to choose investments where the assets will be invested from a set of alternative options. Individual investment choices is simply the administrative ability to give members a choice as to the type of assets they would like to invest and thereby allocate returns on specific fund investments to that member's interests in the fund. It is also acknowledges that individual members have different needs and that a single one-fits-all investment strategy is not necessarily appropriate for all the members, especially in a defined contribution fund where the members are carrying the investment risk. However, the assets remain the property of the fund. The individual members can just select which funds they want to invest in. Right, let's have a look at what the trustee must at least do. Number one, the trustee must determine, in accordance with the rules, what investment alternatives are to be opened to the members. Secondly, determine, in accordance with the rules, how the resources of the funds are to be invested in circumstances where the members make no choice. 3, give the members prescribed information in relation to the investment alternatives open to them. And 4, take reasonable steps to ensure that members have any further information necessary to enable them to make an informed decision with regard to investment alternatives open under the rules of the fund. Trustees can take particular steps to ensure members exercise the investment opportunities properly. And on this slide, we've given you just a diagram of progression. The trustees could limit the number of investment portfolios in terms of the rules of the fund. For example, to 3 or 4 portfolios that have been selected on the basis that they are secure investment vehicles. Alternatively, the trustees could consider establishing portfolios to reflect different levels of risk for portfolios, low, medium, and high. For example, younger members may wish to have relatively more equity exposure than other members. Or the trustees should always establish a so-called default portfolio for members who do not feel properly equipped to make individual choices. And the trustees should ensure that the members are properly educated on the individual investment choice and that they receive adequate information on each investment portfolio in a clear and unambiguous manner. The trustees will have the duty to guide members with regard to the advantages and disadvantages of each portfolio relative to their individual members' circumstances at the time. And the trustees should ensure that proper systems are in place to continually monitor each member's investment choices. And finally, since the physical exercise of any investment choice could be costly, the trustees could consider allowing members to make changes in portfolio choices only at certain intervals, for example, annually or so, not to run up exorbitant administrative costs for shifting, the portfolios and the investment portfolios for their members. Right, appointing an investment manager. Where the fund employs the services of an investment manager to manage the investments of a fund, it would be a breach of fiduciary duty for the board of trustees to appoint a company or person without satisfying itself that such a company or person is properly qualified. This selection of the investment manager is one of the most critical decisions that the trustee must make, as it will determine if the fund will meet its objectives in the long term. Identifying suitable investment managers starts with a simple statistical analysis, wherein a survey is conducted on the different managers depending on the portfolio the fund wants to consider. The process does not only aim at identifying the historically best investment managers, for example, traditional ratings, but also competent investment managers in different market conditions to ensure that the fund can survive the different economic cycles. Right, trustees should, when selecting or appointing an investment manager, consider the following critical factors. Number one, the philosophy of the fund. Is the investment manager investment philosophy compatible with the views of the trustees? The people. Does the investment manager has a stable team of well-qualified people to assist him? The portfolio. Does the investment manager offer suitable, adaptable investment portfolios? The performance. Does the investment manager have the sort of track record that inspires confidence in his ability to perform during both good and bad times? Strategies. Are the trustees comfortable with the strategies adopted by this investment manager? Infrastructure. Does the investment manager possesses the necessary infrastructure for research and analysis of investment markets, economic climates, and so on? And then finally, risk. What is the profile of the investment manager as measured by past performances? Right, then monitoring fund investment performance. The trustee should monitor the performance of the appointed investment manager or the fund where they manage the assets performance, even if the members' contributions and benefit levels are defined and the employer has consistently met the contribution rates recommended by the actuary. The overall investment returns is still relevant to members of a defined benefit fund. There can be little doubt that good investment performance enhances the security of pension promises, while bad performance weakens that security. It is therefore vitally important that trustees know their funds maximizing its investment return within the objectives that they have set. The benchmark the board of trustees set in the normal measure of a fund investment performance, a comparison with other retirement funds of a broadly similar nature can also be made, and this is usually done through a participation in a performance measurement service. How do you mention or measure investment performance? Traditionally, investment surveys concentrated on nominal returns, for example, actual returns achieved by participants. There is, however, increasing recognition that this is just as important to measure the risk or the volatility inherent in achieving the returns. Investment returns is quite meaningless. One needs to judge an investment return given the level of risk taken to achieve that return. The trustees and the investment consultant should agree on the benchmarks used to measure performance. Examples of this would be long-term benchmarks based on long-term consumer price inflation or CPI. For example, CPI plus 5% over a rolling 5-year period as the benchmark, or the passive benchmark is based on the weighted allocation of the underlying manager's benchmarks. Right, how do we measure investment performance for underlying assets? Here is some of the following indexes that we can use as benchmarks. If we look at equities, we can use the FTSE, or the FTSE JSE All Share divided by SWIX. The bonds, the BISA All Bond Index. Cash, the STEFI Composite Index. For property, the FTSE JSE SAPI Index. For foreign asset equities, the MSCI World Equity Index. And for foreign assets in bonds, the Barclay Capital Global Aggregate. So these are some of the indexes and benchmarks that can be used to determine and measure investment performance. How do we measure risk? The measure commonly used for risk is the standard deviation of the monthly returns. It measures the extent to which the returns over several years vary. A high standard deviation reflects high volatility or risk. Conversely, a low standard deviation would reflect a low risk. Other risks and reward measures include return per unit of risk. It unitizes the risk and attaches a return to it. In this case, the higher the return per unit of risk, the better. These are commonly used measures. Of course, there are many sophisticated mathematical and statistical measures of various components, but suffice it to say that risk and return have a strong correlation, and one needs to be viewed in terms of the other. Right. The investment management agreement. An investment management agreement formalizes the relationship between trustees and the investment manager and complies with the general requirements of prudence. Investment management agreement also regulates the liability of investment managers to the fund. Therefore, an exception clause contained in the agreement should be considered by the trustees with particular care. Investment manager termination. Terminating an investment manager's appointment should not be taken lightly. Trustees should avoid judging performance on a short-term basis. However, trustees also need to be prudent to avoid remaining with a manager who is no longer delivering value. The appointment should be reviewed or terminated if, in the opinion of the trustees, the investment manager does not meet the agreed investment objectives within the agreed timeframes. Poor investment performance over extended periods compared to his peers. There is a significant change in the team management, the assets, such as the departure of key investment decision makers on the portfolio or an overall management change. There is a significant change in shareholder of the company. Then one can look at terminating the investment manager. There is a change in the manager's investment philosophy or process, and such changes are no longer compatible with the view of the Board of Trustees. There is a significant change in the business operations affecting the manager's financial viability. There is regulatory non-compliance by this investment manager. The conditions of the mandate agreement is not adhered to. The fund's investment strategy has changed and is not in agreement with what we as the Board of Trustees decided. Any decision to change investment managers should, however, be quite categorically and considered all relevant factors. The period under consideration must be significant, not only short-term. The reason for stressing this is that performance measurements over short-term horizons and the results thereof are often of very little value or relevance to the determination of performance and the achievement of the aims of a long-term retirement fund strategy. Social responsibility investing. Social responsible investing, or SRI, also known as sustainable, social, conscious, or green or ethical investing, is an investment strategy that seeks to consider both financial returns and social good. Social responsible investors generally encourage corporate practices that promote environmental stewardship, consumer protection, human rights, and diversity. Some funds avoid businesses involved in alcohol, tobacco, fast food, gambling, pornography, weapons, undemocratic governments, and or military equipment suppliers to war zones. The above concerns are sometimes summarized under ESG issues, environment, social justice, and corporate governance. Code for Responsible Investing in South Africa, CISA. The Code for Responsible Investing in South Africa guides how institutional investors, retirement funds, should execute investment analysis and investment activities and exercise rights to promote sound governance. There are 5 key principles. Principle 1 is an individual investor should incorporate sustainability considerations, including ESG, into its investment analysis and investment activities to deliver superior risk-adjusted returns to the ultimate beneficiaries. The code requires institutional investors to develop policies on how they incorporate sustainable considerations, including ESG, into the investment analysis and activities. Institutional investors should ensure that this policy is implemented and establish processes to monitor the compliance with the policy. Principle 2, an institutional investor should demonstrate its acceptance of ownership responsibility in investment arrangements and activities. The second principle requires institutional investors to demonstrate a responsible approach to shareholding by, among other, implementing a policy detailing mechanisms of intervention and engagement with companies when concerns have been identified, as well as the means of escalating if concerns raised cannot be resolved. The code requires such a policy also to detail the approach to the voting at shareholder meetings, including the criteria to be used in reaching voting decisions and public disclosure of full voting records. The institutional investor should also introduce controls to prevent insider trading as defined by the Securities Services Act. Principle 3, where appropriate, institutional investors should consider a collaborative approach to promote acceptance and implementation of principles of CRISA and other codes of standards applicable to the constitutional investor. Institutional investors are encouraged to work with other shareholders, service providers, regulators, investee companies, and ultimate beneficiaries to promote CRISA and sound governance. Principle 4, an institutional investor should recognize the circumstances and relationships that have potential conflicts of interest and proactively manage these when they occur. Institutional investors are encouraged to develop a policy of preventing and management conflicts and establish processes to monitor compliance with this policy. And then the final principle, principle 5, institutional investors should be transparent about the content of their policies, how the policies are implemented, and how CRISA is applied to enable stakeholders to make informed assessments. The code requires institutional investors to disclose to stakeholders at least once a year, fully and publicly, to what extent the code has been applied. If an institutional investor has not fully applied one of the principles of the code, the reasons should be disclosed. Disclosure as well as policy should be made public. Institutional investors and their service providers should also carefully consider the reasons put forward to justify confidentiality before agreeing to a proxy or other instructions to keep voting records confidential. Right, let's look at the impact of recent economic developments on investments. And here we think especially of COVID-19 effects on retirement funds. The COVID-19 virus and the subsequent global lockdowns have had far-reaching implications for all walks of life worldwide. And the retirement fund industry was also massively impacted. As of the end of March 2020, the Johannesburg Stock Exchange had lost 25% of its value. Investment markets were severely impacted, leading to negative investment returns of fund investments, only comparable to the 2008 financial crisis. There have been developments in the retirement fund space during the lockdown, which are important for members to take note of. Pension fund administration has been specifically included as an essential service in the regulations issued by the Disaster Management Act of 2002. The FSCA, the Retirement Fund Regulator, also issued two communications on COVID-19. The FSCA Communication 11 of 2020, employers facing financial distress are afforded relief in respect of payments of contribution, provided rules are amended and approved by the FSCA. FSCA Communication 12 of 2020, boards of trustees are encouraged to clearly communicate COVID-19 developments and risk management strategies to fund members, promote calm and minimize risks of premature fund withdrawals. Because there was a lot of questions with clients seeing the markets has dropped so severely and there was no surety about what is going on with COVID. Shouldn't they rather take their pension funds and run? And they had to really calm the market to stop this from happening. On the 26th of March 2020, rating company Moody's cut South Africa's credit rating into sub-investment grade Baa3 or Ba1 with a negative outlook. South African banks were also subsequently downgraded. Unfortunately, foreign pension funds will not be able to invest in South African bonds due to the risk associated with this downgrade. The downgrade means the government will be saddled with higher borrowing costs that will in turn increase the cost of funding of vital services such as health and education. And what is the impact of the downgrades? This is our last point in this session. A higher government borrowing cost will crowd spending on much needed social infrastructure and economic programs. A knock-on effect to business sentiment leads to reduced foreign direct investment and lower investment, resulting in weaker growth and increased pressure on employment. And a more depreciative currency leads to higher import goods costs, which could raise inflation. And as we have seen of late, our inflation rate has gone outside of the band of 3 to 6% as set by the South African Reserve Bank. This concludes our session on retirement fund investments. The next session will be unit number 7, where we will look at retirement fund benefits. Thank you for attending this session. I'll see you then when we discuss unit 7, retirement fund benefits.